Hi, this is A.K. Asnani from Smart VRC, and we are in fact celebrating the 21st year of Smart VRC. We are not passing on your data, any kind of data, to third party. It remains with us only, and be assured for that. So the topic is find your edge and win in stocks. Yes, without edge, one cannot succeed consistently in stock market. So what is that edge, whether you have or not, and how to identify that? So at the core of the core, there are 5 kinds of investors in any company. These are the mutual funds, foreign institutional investors, or often represented by FIIs. Then we have retail investors, including high net worth individuals, what we call as HNIs, and then the promoters, and then the others. Others means that can be corporate bodies or pension funds or whatever is remaining from the above that comes under others. So this is the typical type of a shareholding pattern, and this is the shareholding pattern of Reliance Industries as on 31st March 2001. Yes, about 20 years back. Promoters were holding 43% stake, mutual funds 11%, FIIs 17%, retail investors 16%, and others 13%. So this was the uh, shareholding structure of Reliance Industries as on 31st March 2001. Now this is the latest shareholding pattern as on 31st December 2020. Promoter stake, which was 43%, is now 51%. It has increased, and probably because of the merger of the subsidiaries and other companies with the core company, Reliance Industries. Then mutual funds, which were holding 11% stake, are now holding 5% stake. Foreign institutional investors, which were holding 17% stake, are now holding 25% stake. Retail investor, who were holding 16%, now has come down to 9%, and others is more or less almost same, 13% and 10%. So this is the change in the shareholding pattern. Share price as on 31st March 2001 was rupees 78, and as on 31st December 2020, share price was 1985. So during these almost 20 years, share price has multiplied by 25 times. 25 times multiplication in little less than 20 years. So who were the major gainers? The major gainers were the promoters, as you can see. From 43% to 51%, and promoters are still holding the shares, right? Mutual funds, I'm very sure hardly there is any mutual fund which is holding stock of Reliance Industries for these last 20 years. Keep on changing. Mutual funds themselves keep on changing, and in fact, their stake has also reduced by more than 50%, from 11% to 5%. And then we have FIs. FIs have increased their stake, but again, there is very low probability that any FI is still holding the shares for the last 20 years. And retail investors have reduced their holding from 16% to 9%. As it happens with almost every company, whenever the share price starts moving up, the retail investors start making an exit. But even in a company like Reliance, you can see the stake is almost half. Why I am saying even in Reliance? Because there are a lot many investors who strongly believe in the management of the company, that they have never made a loss by holding onto Reliance. And still, considering the size of the company, 9% stake by retail investors is pretty high. And that credit goes to the management, to the company's performance. But I'm again very sure not many retail investors are holding the shares for these 20 years, maybe around 1% or somewhere about 1.5% investors may be there who are still holding from long term. So the crux is, it is the promoters who have gained the most and then the others. But the first is the promoters, right? So one by one, we will consider the category of investors. The first in line is mutual funds. Fund manager is highly qualified in terms of academics as well as the experience, of course. But unfortunately, fund manager is not able to invest and disinvest at his own will, because he has to look after the redemptions given by the investors in the mutual fund. So the timing of investing the funds or disinvesting depends on the investors and not on the mutual fund manager. He can change over the stocks, but net buying or net selling is more or less dictated by the investors. So, and investors, we know very well, they become fearful and greedy at exactly the wrong times. Expense ratio, yes, mutual funds, the active mutual funds have an expense ratio of about 2%, and every year that 2% as a fees the mutual fund investors have to pay. Fund manager is always on his toes to outperform the underlying benchmark stock index. Every mutual fund has an underlying index, and the objective of the fund manager is to outperform that index. That is how its performance is measured. So he's always on toes. Yet more than half of the fund managers are unable to beat the underlying index. As I said, probably because of the emotional nature of the investors. And investors, they move in herd because of the reason that they feel safe. When they move together, they feel safe. In reality, it is the other way. Coming to the foreign institutional investors, allocation with regard to the amount to be invested in a country is decided by the headquarters, which is situated overseas in their country of origin. They strongly depend on the rating assigned by global rating agencies. Yes. Their performance measurement is by the profits they generate, of course. They invest in highly liquid stocks. Yes, that is their prime requirement, because they purchase in lakhs or in maybe in crores of shares, and they need to invest in stocks which are highly liquid, so that if the need arises, they can liquidate easily. Generally, they invest in sector leaders, and most of the sector leaders are overvalued often. They are scary by nature due to strong economy at home country. So whenever there is a crisis-like situation in say for example in the emerging markets or say in India, then they quickly move off. They quickly sell and move off to their own country. In most of the cases, it is the USA, because they have got a very strong economy. So this was all about the FIs. Then coming to the high net worth individuals. High net worth individuals by themselves, they don't have a valuation understanding, because their main course of business is something very different from stock investment. They have the money, but they don't have that much of understanding of the stock market. They mostly invest through an advisor or they avail the PMS service provider's service. And returns are in general better than mutual funds. And most of the PMS service providers, they offer good returns compared to the mutual funds. And there is a fees also for that. And advisors, PMS service providers, they generally charge a fee of 2% of the portfolio value, that is the assets under management, plus a variable fee based on certain criteria of the profits earned. So the minimum investment required to avail the service of a PMS is rupees 50 lakhs. So for a small investor with an investment portfolio size of say 20 lakhs or 30 lakhs, they don't have recourse for PMS. So they have to go through either an advisor or on their own. Coming to the promoters, promoters are the most knowledgeable about their business. Naturally, they are running the company. They know the most about their business and they have the most confident, they are the most confident persons, confident shareholders, and they have a strong conviction in their actions. They are not perturbed by the share price ups and downs. They are focused on their business. They are not much bothered about the share price movements. And most of the promoters are invested in a single company. They don't have multiple investments. They are running a single business. They have their whole money invested in that company. Yes, of course, at times, whenever they feel like that their share price is undervalued with respect to the real worth of the price, they do go for buybacks. And via buybacks, because they don't participate in the buybacks, so in most of the cases, so they are able to increase their stake in the company. Coming to the retail investors, they have a very poor understanding of a business because of two reasons. One, those who are in a job, they are an employee, so they are not able to see the company as a whole in terms of the finance, how the company is making profit, how much the company is making profit, and all those things. And secondly, even if those who are in business, they are not able to correlate with the company where they have invested. And most of the investors, that is the retail investors, have a focus on share price rather than on the value. They are very much focused on the share price. If you ask, I'm very sure if you ask anybody what is the share price of Reliance, he will tell you. But if you ask what is the value of the Reliance shares, hardly anyone can reply you, not even your broker. More than 90% of the total retail investors involved are involved in day trading or short-term investing. Of course, among the lot which is here, who are participating in this webinar, I know are more than 70% involved in fundamental investments, because we have that category, that type of mindset, that type of advice we provide. And there are some investors who are also engaged in short-term investing, I know very well. And some short-term investors are here just to look for that what kind of edge is required to make money in the long term from stocks. Herd mentality, yes, they always move in group, feeling safe. They have least control on emotions. Yeah, they are very greedy as well as they are very fearful. Always give you an example. So yesterday, day before yesterday, market fell by 2,000 points, and I'm present in a number of other WhatsApp groups, and I keep monitoring what kind of posts are made or how many posts are made in a day. And I found that the number of messages in such groups fall down by 70 to 80% within a day. So they are very much emotional whenever the market falls. The fact is, I become very happy. I become very excited that I may get an opportunity to buy at low prices. But in general, the retail investors are not happy because their total worth of the portfolio is falling down. Okay, so they have got the least control on emotions and very low level of conviction, because most of the time they have purchased on the advice of a friend or on the advice of a neighbor or on the advice of a broker or on the advice of some social media. And so they don't have their own confidence, own conviction. As we have got, they act mostly on hearsay and they hardly create any wealth. In fact, over a period of time, maybe 3 years or 4 years, most of the retail investors, they make loss and quit the market permanently. Yes, and then the new breed of investors come into the market and this cycle keeps on moving, repeating. There are hardly 1% or 2% of the investors who are really creating the wealth. Often retail investors stand for nothing and hence they fall for anything, because they don't have any conviction, because they don't have any confidence in the stocks they have purchased. So whenever the market falls by 10% or 15%, they quickly make an exit. So the question arises, we all being retail investors, what is your edge? Why should market reward you for your actions? Why market should consider you better than the promoters, better than the FIs, better than the mutual funds, better than the HNIs, and better than the other investors, other retail investors? Why? What is your edge? क्या है आपके पास कि market आपको reward करे? There should be something. Otherwise, you are just like other investors, and then your returns will also be just like other investors' returns. And as we have seen, retail investors are the last one to get benefited from buying the shares. Yeah, as we have covered, not even 1% investors make consistent money from stocks. This is my own source, is my own. Whenever I go for seminars and workshops, or even in webinars, we have taken a number of times the feedback that how many investors have made money more than the BSE Sensex. There are hardly 2% investors. So the question arises, why should we be counted amongst the 1% of that successful investors? What you have that others don't? First is the understanding of a business. Yes, what you are buying, what company you are buying, what that company is doing, what that company is going to do in times to come. What is the impact of the movement in raw material prices? What is the impact of corporate tax on your company? You should understand the business. You should understand the impact of other things on your company. Easier said than done. It is really difficult for an investor if he is not trying to correlate with his own income. Yes, try to understand the business with respect to the income you are earning in your family. What is the source of income? How much you earn? How much you distribute in various expenses? What you are buying is an asset or a liability, right? The same is the case with corporate. What the company is buying, whatever the company has purchased, is it on its own funds or it has been on debt? As we buy a house, when we buy a house, most of us, in fact, more than 95% of us, we purchase on debt, right? Similarly, whenever we buy a car, most of us, we purchase on debt, but car does not gives you any returns. There are no debt returns. In fact, it is a liability. Yes. So we should be able to differentiate. Similarly, in case of corporate, there is 1:1 correspondence with the whatever we do in our household. The same thing we do with the corporate. Finding the value I tell you, nearby to my house, there is a shop who keeps more than 90% of the items are of the companies whose name I have never heard. But I do get good quality clothings, good quality of the, the cloth he uses. So he is a value buyer. He knows that what is the worth of that cloth. And we, the person who are visiting that shop, we also know the worth of that cloth. So that is a value buying. So and when we go to the, say, when we go to the Park Avenue shop, so we are not looking for the quality of the material because we know that it is a Park Avenue, so it has to be a good quality. But when you are going for a brand where you do not know, you have not heard of the brand name, then how you will buy? You must know how to value the cloth. Similarly, you need to know how to find the value of a stock. There has to be some value. Everything has a value. When we purchase a computer, we purchase a soap, grocery, every item has a value and we pay that value. So for any stock also, there has to be some value. And it is not that difficult, but often retail investors find it very difficult to find the value of a stock. Of course, there is no clear formula. As I said, when you purchase a ready-made cloth of an unbranded value, there is no ready-made formula to find out how much it should be worth. But it is through our experience. It is through our past good or bad experience with that kind of cloth. Long-term approach. Yes, if you are a long-term investor, often investors say that they are long-term. First of all, what is long-term? Long-term means minimum 5 years. Minimum 5 years investment. Why 5 years? Because every business cycle has a period of roughly of about 5 years. Sometimes it gets extended to 6 years. Sometimes it gets compressed to 4 years, but average is 5 years. So there is a approach. Often investors say that yes, they are going to remain invested for long term, say 5 years. As soon as the market crashes by 10% or 15%, I should not say the word crashes, it comes down. If it comes down by 10% or 15%, their share price comes down by 25%, 30%, and they make an exit. Where is the long term? No long term. They are very much focused on the price. They are not focused on the horizon. Invest for long term. Invest in a good business. Find the value of that business. Allocation, when I say allocation means how much weightage we should provide to a particular stock. That also plays a very crucial role in determining your total returns. Control on emotions, of course, emotions can be controlled to a certain extent only and if only we understand what we are doing. If you are doing speculation, then definitely it is very difficult to control it. Emotions. But if you are doing a real investment, if you know what is the worth of the stock, then you have the confidence, you have the strong conviction, and that comes through experience. So that emotions get automatically covered when you have the confidence in your picking the stocks. That is a direct relation. A rational approach. Okay. Most of these points we have already covered. Why is such high failure rate of retail investors? They feel safe by acting in herd, and they look at day-to-day market. They say that they are long-term investors, but I'm very sure majority of the long-term investors, so-called long-term investors, are daily watching the share prices, and most of the retail investors, they are looking for 25% returns in a week or 10% returns in a week, but even 25% returns per year means 10 times in 10 years and 100 times in 20 years. Yes, even with 25% returns per year, it will multiply almost by 100 times in 20 years. We all watch the same television channels, but majority of the investors, they watch the television channels only for the share prices. What you have to look for is the interviews of the CEOs, the CFOs of the companies, what they are saying, what they are expecting about the company in times to come, what are their expansion plans, what acquisitions they have made. We all read the same newspapers, but there are few investors who read between the lines what is not being said. Yes, you have to read, you have to understand what is not being said. Just from their tone, you can make out. And lack of focus. We are not working with a focus. We are not investing with a focus. There should be a clear focus. So these are the reasons. I have tabulated it. The same things what we have covered for the promoters, FIs, mutual funds, HNIs, and retail investors. And yes, I have covered one more. That is risk. Promoters have a high risk. Yes, what you are seeing is the successful promoters. What you have not seen, what you do not know, is the failure of the promoters. So they are at high risk. Well, now coming to the focus, let's have a look at this small video. So that was all about the focus. We are not focused, and as you must have seen, when he made the goal, at that time, all his eyes were all the time were on the football, where it is going, right? And what is the retail investors' focus? Retail investors are always focused on the share price, where it is heading. It should not be the share price. It should be the story company. They should be focused on the story company, where the company is heading, not the share price. Share price has to follow the company, right? So that is the difference. We should always focus on the company. And most of the time, retail investors' vision is very small, very mediocre. He is always looking for 20% returns from a stock like that. So whenever he achieves a 20% or 25% returns from a single stock, he quits and then tries to find out some other stock. This way, what happens that he invests in large number of companies, and it is really very difficult to find a good company. It It is not that easy. And once you have found a good company, then stick to it. As long as story is intact, as long as the valuations are comfortable, stick to it. That is the way to create huge wealth, right? So as happens in case of investors, they try multiple times, but they are not able to achieve their even mediocre vision because of purchasing the wrong stocks, not knowing what to buy, and whatever they get benefit is just because of the market movements. Because of the market, they get returns by chance, not because of investing in a good company for long term. So if you want to come out of this small vision, think big, think for 10 years, 20 years, and rather I will say, think that you are going to invest for lifelong. You need not have, you need not, the need does not arrive to sell the stocks. Yes, that is the way to invest. And for that, you need to change your habits. You will have to change your vision. You will have to change your perspective. And that is what we do, especially in multi-baggers. We are investing for, we are advising for very long term, from 3 years to 5 years. So this was a small video about the multi-bagger service. And in fact, in all our services, all our products, we use the same technique. We find the worth of the stock. We look for constantly, we are focused on the company story. And that is how we pick the stocks. And this is just a sample of last 1 year. What stocks we advised in multi-bagger, and majority of them have achieved the target. During our last webinar, we covered the stock accuracy and story. It is again the story. It made a tie-up with IKEA, Switzerland, and that was the time when we thought, what is going in this company? How IKEA can transform this company? And then we came to know that the company is expanding, and that was the time when we recorded the stock on 23rd of October 2020, and within less than 4 months, it achieved the target of 260, and now it is 308. So story keeps on changing. It is not that what was the story at that time, and today the story is totally different. Today, company says that due to the excessive orders, we are further expanding our capacity for the kitchen sinks. So story keeps on changing. So you have to similarly keep on finding the worth of the stock. With the changing story, the worth of the stock also changes. So you have to be very much focused on the company's story. Share price has to follow. It has to follow. So we are going for a poll. In this is poll 1 actually. It's showing 2. Okay. So the DNA stands for what? We say that it is not in your DNA, or we say that yes, it is in their DNA. So what is DNA? DNA stands for what? So you for deoxyribonucleic acid, or dichloride nitric acid, or disulfuric nitrogen amines, or none of the above. We all have DNA, right? Yeah, a kind of molecule. And okay, 66% participants have voted. Within 5 seconds, we'll be closing this poll. Right. The correct option is option number 1. And we know this term by the short form DNA, but very few of us know what it stands for. Thanks for participating. So DNA is the chemical name of the molecule that carries the generic instructions in all living things. So can you change your DNA? Yes, to an extent, yes. If my dad is doing a business, so it is very natural that since childhood I will be seeing him how he is and doing the performing the his business, what he is doing, how he's arranging the money, how he's spending, how he's buying the things, how he's collecting the money, and all those things. So it comes in my DNA. But it is not essential that if my dad is not doing any business, then I cannot do business. These qualities can be acquired. It will take some time, but these qualities can be acquired. So that is DNA. And so related to this only, do you think you can be a better investor? So that is another poll. The question is, do you think you can be a better investor? Okay. Yes, this was unexpected lines. 93% say that yes, they can be better investors. And there are 2% participants who say that no, they can't be. And there are 9% who say that they cannot say whether they can be better investors or not. Yes, they are also true. Whether you say yes or no or can't say, it is up to you. But I strongly believe that yes, we all can be better investors. There is always a scope for improvement. There is always, it is up to the individuals how much they try, how much they make an attempt, and how much they are focused. It will take time, no doubt. So actually, we all have the characteristics for creating extremely good, extremely high wealth from stocks, but we are not knowing it. We have a lot of things in our subconscious mind, but we are not making a connection with our active mind. So you have to make a connection of your subconscious mind. So say if this is your subconscious mind and this is your active mind, so we have to make a connection so that the active and subconscious mind, that means the conscious and subconscious mind, they act in unison. There are a lot of things you have it, you know how to value a stock, but you are not using that characteristic which is lying in your subconscious mind. That is the edge, you can say, you have. We all have. In different ways we can understand that what is that edge, that we will cover in the coming webinar, and that is going to be very interesting because I am going to give you lots of analogies, and I am very sure at least one of those analogies will be applicable to you. And we are also there to help you in rearranging your DNA. It is there in our mind. As I said, it is there in our subconscious mind. We have to only rearrange the things. And how we are doing it? As you all know, we have a book, Way to Billionaire, authored by myself. Then we provide insightful videos with the name of Smart Insights Pro. And these are the small videos. These are just to share our knowledge and wisdom with retail investors. We also conduct free seminars and webinars like what you are seeing today, thus just sharing our wisdom, our knowledge, our experience with the market, how to create wealth, what to be done to create wealth. This is all about sharing knowledge and wisdom. As I said, it takes time. It is not that simple that you read a book and you become an expert investor. No, you have to keep on reading and keep on investing also, because those theoretical things have to be mixed with the practical ones, and you have to find your own DNA. You have to find your own edge, and to help you how to find the worth of the stock. We are there through our advisory products as well as workshops where we tell you how to find the worth of the stock. That is the ultimate thing, because if you do not know the worth of the stock, then you are playing a game in the dark. You are playing a blind game. So this is a feedback in a very informal chat. The feedback provided by Mr. Bimal Choksi from Mumbai. Smart VRC is probably the most genuine knowledge and research subscriber service from the many hundreds. Smart VRC and Nasrani Bhai, kudos for all the years of honest and fiduciary responsible research. Thank you, Mr. Choksi, for being with us from last 18 years. Coming to the smart word, this is a very good saying by Mr. Charlie Munger, and yesterday I shared in our WhatsApp groups also. Those who are not in our WhatsApp groups, those who have come from your friends in forwarding this message to you, and they can register, they can be a part of our WhatsApp groups. They have to simply send a request on our WhatsApp number 9755920780. So the Charlie Munger, what he has to say is, some people do not have a good temperament for investing. They are too fretful. They worry too much. But if you have got a good temperament, which basically means being very patient, yet combined with that, with aggression, when you know enough to do something, then you just gradually learn the game, partly by doing, partly by studying. Yes, as I said, you have to read the books and you have to apply it to your own investment. Obviously, the more hard lessons you can learn vicariously instead of from your own terrible experiences, the better off you will be. Exactly. You do not have to learn all the lessons on yourself. You learn from the mistakes done by the others who have created wealth, like Warren Buffett, Mr. Charlie Munger, Mr. Peter Lynch, and many more. Shortly, we are going to have a question and answer session, and you can ask in the chat box, or you can raise your hand and I shall ask you to unmute. Thank you very much for your patience and for sparing your so valuable time. Okay, I have received a direct message. Good morning, sir. In your earlier webinar, you have replied to my query that you are 100% invested in stocks at all time. So there is no need to keep extra fund for correction. then how come one uses the corrections to buy good stocks at low value if they are 100% invested? Regards, right? Excellent. Uh, it is like this. Since we cannot predict the market, so that is why I keep saying that remain 100% invested. But the question is, if the market falls, then how to take advantage of that market? So whenever there is a sharp correction, whenever there are lots of inefficiencies, not all the stocks fall by the same proportion. You have to take advantage of that inefficiency. The stock which has fallen the most, and if you find that that stock is pretty more attractive than the stock which has not fallen, then you can switch over. What you are doing basically is you are increasing the beta. But one thing you should remember, we have got limited switching, I should say the switching possibilities. So be very careful. Don't keep on switching frequently. You need to switch if the stock price is down by at least 15% from your last purchase price. Then only it is advisable. Okay, regarding the WhatsApp number, please can you share the WhatsApp number of Smart VRC? Okay, our WhatsApp number is 9755 920 780. I have also mentioned in the chat box for all. Okay, what is the intrinsic value of RIL? Okay, we don't discuss about the stock specific intrinsic values in these webinars. Okay, regarding the WhatsApp number and the other numbers, it is visible. You can see on my right side. When you have a returns of like 300%, isn't it a good idea to book profit and later wait for price to come and invest again? No. We have stocks like Bajaj Finance in our various schemes from last 6-7 years, having more than since 2011. So almost it is 10 years, and we still have, and it has multiplied not only by not by 200 or 300%, but many times. In fact, it is up by about 70 times, more than 70, 80 times, but still we are holding it. So it is not a good idea. If you have got a good stock, good story, and the valuations are attractive, remain with the stock. No need to sell. Don't get focused on the price. You have to see the balance between the price and the worth of the stock. As long as the price is below the worth of the stock, remain invested. On which type of industries we can replace China? It is mostly in chemicals and pharma, and to an extent in manufacturing, but it is still we cannot say how the PLI takes the form. Yes, Mr. Jayanti, kindly unmute yourself. Mr. Jayanti, we are not able to hear you. Is it good to invest in PSUs which have 4 to 6% dividend yield? Always invest for capital appreciation, not for dividend yield, and that is the best way. Why PSUs give you better yields is because they are not expanding, they are not using that money to expand their operations, so they are giving you in the form of dividend. So don't get attracted by the dividend yield. Mr. Umashankar Gupta, kindly unmute yourself.
Yeah, good morning, sir.
Good morning, good morning. Welcome.
So this question is not related to stock market, but about the fundamentals of economy.
Yeah.
Yesterday there was a report about the US ka debt, which is in trillions of dollars, and whereas India's debt is not, is below, a trillion of dollars. So why is still America a stronghold economy compared to other world?
Okay. India's India's economy size is very small. It is about 3 or 4% of the total global economy. But US economy is about 25% of the total global economy. So they are almost 8 to 10 times bigger than India. So bigger the country is, and the more safe it is meant to be. Bigger in terms of the GDP, in terms of the economy, not in terms of the size. And they have most of the innovations are taking place in US only, and dollar is known to be the universal currency, is known as the universal currency. And it is not that only during last 2-3 days only they have accumulated so much of debt. So it is only the media which projects like this. So if the market falls, they have to tell you some reason, and then they come out with some reason that they have so much of debt and so much of things. What we should consider is, if the US has so much of debt, has the products what we buy, has the price come down? Has the price of grocery come down? No. Then how it is going to affect the company in which you are invested? If the US has so much of debt, then how Bajaj Finance will be impacted? How Hindustan Unilever will have an impact? To consider like that. So you should not focus, as I keep saying, you should not focus on what is happening in the market. You should focus on what it will have an impact on your company. That is the key thing. As long as the performance is there, share price has to follow. But it is in the intermediate that the share price will follow the market movements. But in the long term, it will always, 100%, it will always follow the company financial performance. Mr. Ramachandra?
Hello, sir.
Yes, sir.
Can you hear me, sir?
Yes, tell me.
Sir, this is the fantastic and very good knowledgeable seminar, sir.
Thank you.
Thank you for this. And sir, I have a question.
Yeah.
That nowadays on the media that PUC sectors are going very fast, and also from government side they are saying that they are going to it privatizations. So is it a story making in? Can we should focus on it, or should avoid?
How you will focus means how you will come to know that which companies are going to be disinvested and what should be the worth.
Now every company are going up.
I know.
And
Yeah, it is. As I said, retail investors, they always move together, and that
yes,
is that is why the returns of individual investors are always returns of the common retail investor. I
yes,
know
sir.
it is being touted as the multi-bagger because the government is going to disinvest. But what the public does not know is that that particular public sector does not owns the land. The land belongs to that state government. That public sector does not have the assets of more than 1,000 crores. So that is a very small amount. So in general public does not know what is the worth, what should be the worth of such public sector. So it is all in the yes, as you said, there are a number of stocks floating in the social media that these are the public sector which are going to be disinvested, but these are yet to be analyzed. And how to find the value? Finding the value is very difficult. How much land it has and what is the cost? What is the present value of that land? It is very difficult. And how much assets they have, that can be found out from the balance sheet. But most of the public sectors, their assets are almost very low compared to the share prices.
Yes.
So just for the sake of the government is going for privatization, everybody knows that. What is your edge? What is how you are up compared to the other investors? That should be the main query.
Okay, sir.
Thank
you, sir. Hello, sir. Hello.
Okay. Do you subscribe to the view that market is in bubble? What is bubble? Bubble means the worth is almost constant and share price keeps on moving up and way up. That is a bubble. So if you are invested in a company whose performance is not improving and share price keeps on improving, that means there is a bubble formation. But as far as the economy is concerned, I don't think we are in a bubble. Performance of a corporate sector is pretty good for the latest quarter, and going ahead also, going by the GST collections, it is doing reasonably well. So overall market is not at all in a bubble, but I cannot predict the share market. When should we book partial profit? When company is doing good and we are believing in stock and it has given more than 100% returns. As I said, don't get focused on the returns. Always focus on the two things. First is the company story, whether the story is still intact. And secondly, if your weightage has increased to say beyond 10%, then definitely you should think of bringing it down to 10% or 8%. Because excessive weightage in a single company means a factor of risk. So that should be the way, and I do in this way. Yes, Mr. Jeet.
Very good afternoon, sir. Excellent session as usual.
Thank you.
And my query is about the government has recently consolidated many banks into few large banks. They were already large and they have become more larger now. So do you think there is a good opportunity in those few large banks to outperform the market? And is there any possibility of management doing better? Because government, Mr. Narendra Modi has clearly said that government business is not to be business. So will that have a good impact on these big, larger banks of government?
Okay. How many public sectors are there which are doing much better than their counterparts in the private sector? Can you name?
Hardly any, sir.
Hardly any. So whether that bank is small or big, that will remain a public sector. And you know very well, when you visit a State Bank of India is one of the best managed, I believe, one of the best managed public sector bank. So if you visit State Bank of India and you visit Kotak Bank or ICICI Bank or HDFC Bank, and you will find the difference. People are ready to pay a small premium for the quality of services they get at these banks. It is difficult for a government organization, for any government organization, to outperform the peers. The only case where the public sector can outperform the other companies is where they don't have any competition. There was a time when HMT was the #1 company in watches because there was no competition. The day Titan, that is the Tata, they got the license for manufacturing watches, and since then you can see the difference. No, I don't think HMT watches are there in the market. So it is only a question of when the competition arrives. That is my thought process. If you find a good value, you can invest.
Thank you, sir.
You're welcome. Yes, Janam, Mr. Janam Shah.
Hello, sir. Very good session as always.
Thank you.
I wanted to ask, are you going to conduct any workshop offline or online in near future where you teach us how to identify stocks or how to try to find value? Some that sort of workshop that you're planning to conduct in near future. I'm very much interested in doing that.
We have received a similar type of request from other participants also. Yes, we do conduct workshops, but from last 1 year, we have not organized any workshop. Last one was in Rajkot. And we are planning to do it on online. And if it is there, then we will definitely declare. It would be a full day workshop and most probably on Sunday for 8 hours. Whenever there is a date, we will declare in our WhatsApp groups. Okay.
All right. Thank you. And one more question I have. So there are lots of companies, right, to invest in, a lot of good companies, but sometimes it becomes difficult to identify which sector we should focus and in that sector which company we should focus. Like you give to all your subscribers, you have a buy or sell call, right, time to time as per the subscription. So how do you identify which company to pick up now or which sector to enter into? Can you shed some light on that? Because I have been trying to identify stocks and do my own fundamental analysis on that, but I always end up focusing on the ones that are already very famous and already blue chips.
See, the best would be to read the annual reports and to read the management comments when the companies declare the results.
No, but that is the question. Sorry to interrupt. That कौन सी company का annual report पढ़े? Because there are hundreds and thousands of companies that are doing good. So which one to pick? That is the tricky part.
Okay. Yeah, that is true. But at least the companies who are declaring the results and whose management are well known. Say, for example, I will give you an example. You go for Tata Power last quarter results and see the results they have declared, and you see the management comments.
Okay.
If you find it interesting, then you further intensify your research. Then you can go for annual report. You can go for the other expansions, what it has happened, and what it is doing, whether it is increasing the debt or reducing the debt, and all those things. That is the story. What is ahead? What lies ahead? What they are doing in solar power and all these things.
Okay.
The best thing is it should be in a natural way. You should not start looking for where are the good companies. Not like this. You wait for something to appear in front of you.
Okay.
In a natural way. Means let the company declare the results. And if they are good, then try to find out what they are doing. And then you find that the stock is worthy of investment, then you invest. And you have to track the story. That's all. So I have given you a good example of Tata Power. You can find out. I'm not saying that Tata Power is a good stock to invest. What I'm saying is how to initiate the research, how to initiate tracking the story. Okay.
Understood. Thank you.
You're welcome. Okay. Any other query? What is your view on government selling PSUs? Okay. So most of the queries are on PSU banks, and unfortunately, we avoid PSUs. Jayesh Tiwari, kindly unmute yourself. Yeah.
Yeah, good morning, sir.
Good morning.
And good morning, all participants. My query is that, sir, on your advice, you advise certain weightage on particular stock.
Yeah.
And say you advise 3% weightage. So we bought, we kept our weightage at 3% and bought the stock. But after say 6 months or 8 months, whatever, so weightage, valuation weightage increased to say 6%. Value increased and stock done well, and so value weightage becomes 6% on valuation. Then you, what we should do, we should book profit and bring it down again to 3%, or how we should take it forward?
Yeah, if it is consistently reporting good numbers, good financial numbers, then you can let it go, let the weightage go up. Because if I have given you a weightage of say 3%, that means I'm waiting for a better story to come. And if it has really delivered good results, then you can increase your let the automatically weightage increase to 6% or 7%, but let it not go beyond 8%. Beyond 8%, we should hold only for the stocks for which we are very, very confident.
Okay. And sir, you also often advise that one particular sector should not have more than 15% weightage in your entire portfolio. Say banking. In banking, we are holding 5 stocks or 4 stocks. The collective weightage becomes 18%. Then it's time to reduce the weightage by 3%.
See, it all depends. Means if you are following my advice, then in the banking is a kind of exception. I can go up to 25%. But it is up to you. Means if you are ready to take the risk, because as you increase the weightage in a particular sector, then definitely there is a associated risk also. But if you feel that economy is doing very well, government has announced very good budget, and you feel that the economy should perform very well going ahead, then without banking, economy cannot perform.
Yes, I got it, sir. Yeah. Thanks a lot, sir. Thank you.
Okay. This is very interesting. Don't you think that the world is changing and now it's high time for undervalued PSU sector as a whole to outperform over next decade? See, that is what you are saying is an undervalued kind of thing. Most of the public sector banks, they have very high level of NPAs, right? And government is running short of funds to keep investing, to keep providing capital to the public sector banks, and that is why they are going for privatization. And rest of the public sector we have discussed a lot in this webinar. Okay, with this we have come to the end of this today's webinar. Once again, I thank all of you for sparing you so much of time and listening patiently and also asking good questions. We'll continue with this subject in our next webinar, probably on coming Sunday. Thank you very much. Namaskar.